Welcome to today's webinar, S Corp, Is It Right for Your LLC? Brought to you by the NFIB Small Business Legal Center. To our current NFIB members, thank you so much for being an active participant in the small business conversation and for your continued support. To those who are not yet members, welcome and consider joining the nearly 300,000 small business owners who are fighting for small business with NFIB. Our success is based on strength in numbers. Each new NFIB member makes your voice a little louder and strengthens our efforts to fight anti-small business legislation. If you are or know a small business owner who needs their voice to be heard, visit NFIB.com or call 1-800-NFIB now. And before we move on to our presenter, there's a few things I'd like you to keep in mind. If you have any issues with audio, ensure your computer speakers are set up properly and know that your internet connection does affect the clarity of sound. We are recording today's presentation, and after the webinar, all registrants will receive an email with a link to the recording and a link to download the slides. We encourage you to enter questions in the Q&A box on the right of your screen. Just click Ask a Question and type your inquiry. We will address questions at the end of the program. And while we typically get many questions during these webinars, even if we don't get to your particular one, we hope we will answer one that will be helpful to you. And I'd like to introduce our speaker today. Jamie Truel, CPA, is the owner of Balance CFO, a financial literacy coach and profit strategist for small business owners. Jamie received her bachelor's degree in analytical finance and a master's in accountancy from Wake Forest. She started her accounting career at Ernst & Young, one of the big four public accounting firms, and then spent 10 years at Coca-Cola System, rising to a leadership role in finance. And as we have Elizabeth Melito, Executive Director for the Small Business Legal Center. And now I'll hand things over to Jamie. Thank you so much for speaking with us today.
Hi there. Thanks so much, Casey. I appreciate the intro. I'm really excited to be here. Hopefully everybody can hear me. But I'm excited to talk about this topic because this is one of my favorite topics to discuss. And I think it's something that's relevant to a lot of small businesses. So if you are here joining us, hi, I'm glad that you are here. And you can put your questions in the chat. We're going to get to some Q&A at the end. So this is the S Corp switch. Is it right for your business? So we're going to talk about that. Again, pretty much every business is going to come to a point where it's going to make sense to really be thinking about this and assessing this. So we're going to talk about how to, first of all, understand exactly what it means to be an S corporation, and then also how to figure out if it's right for your business and when. So let's jump on in. Of course, I got to give the disclaimer. So this is provided for educational purposes. This is not a substitute for your own legal, tax, or financial advice. I am a CPA, but I'm not your CPA. Okay, so first, before we get into it, I like to just tell you a little bit about myself. I'm a little bit of an atypical CPA. I actually don't do services anymore. I am pretty much entirely a financial educator because that's what I love. And so, like Casey said in the beginning here, I am a CPA. I have my bachelor's in finance, my master's in accounting. So I'm a massive numbers nerd. I started out my career in the corporate world in financial reporting and technical accounting for Coca-Cola, Fortune 500 company. And then I just found that, again, I really liked the education side of business. So I first started becoming a virtual CFO to help small business owners with their individual businesses. And then I realized that education was really my sweet spot. I love doing things like this, where we get to talk about these things. And so I have my own educational programs, and I even have a book coming out this October. So I'm really excited. The book is being published in October of 2025 through Simon & Schuster, and it's called Hidden Profit. So please be on the lookout for that. I'm excited to add author to my resume as well. So let's talk about where we're going in this conversation. And I really do want it to be a conversation, so definitely put those comments in the chat so that we can I can answer your questions at the end with any time we have left. So first, let's talk about what really is an S Corp election. And this is important to get really clear on because there's actually a lot of confusion. People don't necessarily realize what it is and what it isn't. So we're going to talk about that first. Then we're going to talk about the benefits of the S Corp election, right? So what exactly are we getting by being an S Corp? That's really important to understand. Even if you're working with an accountant, the small business owner needs to know enough about this to understand exactly where these benefits are coming from so that you can make the best decision for your business. How much can you realistically save? This is the question I get all the time, right? How much can I save? And of course, the answer, my CPA answer is it depends. But we're going to talk about how to determine how much you could realistically save and actually walk through some numbers. Like I said, I'm a numbers nerd. I like examples. So we've got lots of great examples in here to give you an idea of how much it could save you. Added requirements for being an S Corp. So it's not all sunshine and rainbows. Electing S Corp tax treatment actually has some things that you need to do as well. And this is, again, one of those issues that trips small business owners up and that you do need to be aware of. So we're going to talk about that. We're gonna go ahead and do some myth busting. I always do this in my presentations. We talk about the things that you may have heard out there, and we're gonna bust some of those myths and talk about what the truth is when it comes to S corporations. And then how tax pros can get it wrong. I love my tax pros. I am, again, a CPA, but sometimes some of the very common knowledge in this area is actually incorrect and not up to date. So I want to tell you how tax pros can get it wrong so that when you are talking to your tax professional or looking for one to do some of this work for you and do this analysis for you, you know what to be looking for and what kinds of questions to ask to determine if they really know what they're talking about. And then we're going to take that Q&A. So hopefully we can do all of this in a 45 minutes to an hour time frame. So stick with me. There's a lot to cover. If you want to take pictures of any of these slides, you can go ahead and do that too. There's a lot of words on here. So if you want to be able to revisit that, that might be a good option to do. Okay. First of all, what is an S Corp election? Okay. And this is important, again, because there is an understanding. A lot of times you might say, well, I'm an S Corp, right? If they ask you what type of entity you are, a lot of businesses that are taxed as an S Corp will say they're an S Corp, but they're not really an S Corp, not at least from a legal standpoint. So it's important to understand that when we're talking about what entity we are, there is a legal entity and there is a tax entity. And if you don't make any kind of tax election, every legal entity has kind of a default taxation. So for example, if you're an LLC and you have not made any kind of S Corp election, right? Your default entity or your default taxation is going to be sole proprietorship taxation. That means you file a Schedule C that's part of your normal 1040 tax return. All right. So that's how it works. Whether you're a sole proprietor or an LLC, you're going to be taxed as a sole proprietor. And your legal entity in that case, if you've actually formed the LLC with your state, is an LLC. Now, you might be a single member LLC, you might be a multi-member LLC. If you're a multi-member LLC, you're typically taxed as a partnership, right? So again, that means you're filing a partnership return. So those are things to really understand in this conversation, because when people tell me, oh, I'm an S Corp, I usually ask them, okay, but what's your legal entity? Because you can be an LLC taxed as an S Corp, or you can be a C Corp taxed as an S Corp, right? And those are very different things from a legal perspective. So that's where, just from a vernacular perspective, right? The legal entity is the actual legal entity you've created, likely with your state. The tax election is how you've elected to be taxed, right? And if you don't make a tax election, you're going to get a default tax election based on your legal entity. I hope that makes sense, but I think that's an important just level set, because I just find that we confuse some of the terminology around this. And so just making it clear, this is a tax election with the IRS. This changes nothing about your legal entity structure. It just changes your, how you are taxed from an IRS perspective. Okay. So let's talk about S Corp benefits. Why would someone do this? Why would you want to do this? Now, most of this presentation, just to give you a basis, is going to be comparing. This is really about comparing an LLC without an S Corp election, meaning you're taxed as a sole proprietorship, to an S corporation, right? Which means that you're going to be taxed as an S Corp. So an LLC. So we're comparing LLC versus S Corp. We're not in this presentation comparing C Corp versus S Corp. That is a different set of comparisons, right? So we're not going to get into that in depth, but just know that that is also an option for a C corporation to be taxed as an S Corp. Most of the time, they're going to do that to avoid the double taxation that you get with C Corps. But again, that's not what this presentation is really focused on mainly. Okay, so when we're looking at LLC versus S Corp then, what would be the benefit of being taxed as an S Corp? Well, the main benefit, this is the biggest one. This number one is the biggest one. There are other ones, but number one is the biggest one. It's the main reason you would choose to do this, and that's tax savings opportunities, specifically around self-employment tax. So just as a reminder, as an LLC, all of your profit, right, revenue minus expenses, is going to have both income taxes and self-employment taxes on it. Self-employment taxes are Social Security and Medicare. Okay, so that's 15.3%. Why is it 15.3%? Because you have to pay, as a self-employed person or a small business owner, both the employee side and the employer side. So if you were to go work for somebody, you'd still have Social Security and Medicare taxes. They would be called payroll taxes instead of self-employment taxes, but it's the same thing, right? And in that case, your employer pays half, 7.65%, and you pay half, 7.65%. However, when you're self-employed, you're paying that entire 15.3% yourself, because technically you are both your employer and the employee. So yay for us. But again, you're only paying that on your profit, not your total revenue. So that's important to note as well. We get to deduct expenses as business owners where you can't do that as an employee. So that's where the savings comes in. It doesn't mean you don't pay self-employment taxes at all, but you limit the amount of your income that is subject to self-employment taxes as an S corporation if you do it correctly. That's where the benefits come in. I'm going to do a calculation here in a minute just to kind of drive this home and show you how this works. But what are some of the other oh, yes.
Sorry, 1 second.
Yeah.
Can you reshare the slides? It doesn't seem to be, they don't seem to be working anymore.
Oh.
I want to make sure that folks can see. Okay, wait. Now that you've moved your mouse, I think that now it's taking.
Oh, strange. What was it doing?
It had paused only on the title slide and it wasn't updating. But I think now, I think
strange.
you just needed to, I think it needed to know that you were still there. Okay.
Yes.
All right. Thank you.
Okay, I'll try to keep some activity going so that it doesn't give up on us. Okay. So the other benefits, if we go into benefit number 2, hopefully you guys can see this, is benefit number 2 is business loan qualification. So again, this is kind of a secondary benefit. If point 1 doesn't work, if you're not going to save money, it's probably not going to make sense for these other reasons, right? These are almost more secondary benefits if point 1 makes sense for you when you do the calculation. All right. So business loan qualification, oftentimes lenders can look more favorably, again, especially when we're comparing S Corp to an LLC, right? On anyone that is appears to be more of a legitimate business, if that makes sense. So that's going to help you with funding, things like that. Again, not a reason to do it on its own, but a nice side benefit if it makes sense from a tax perspective. Mortgage qualification, same thing, might look better to lenders than being an LLC where you don't have a W-2, right? You can't give them pay stubs because you don't have any. You will have pay stubs as an S Corp. Again, you do run payroll. We're going to talk about that in a minute, but that can make it easier for other types of loans like mortgage loans for yourself personally. It is easier to sell or transfer ownership. An LLC is a little tough. If your tax is an S Corp, it does make that process a little bit easier and more administrative or less administratively burdensome to be able to do that. And it might be more attractive to buyers. Okay, but let's go back to kind of the main reason here, because this is what really matters. And this is where we're talking about tax savings. This is what y'all probably care about the most. So let's do a quick example with some actual numbers. So let's say you make $100,000 in profit in your business before paying yourself. Okay. Let's say that's you. $100,000. Again, this is profit after the expenses that are deductible for taxes. Your total profit is $100,000. And then you determine your reasonable salary for the work you do is $60,000. We're going to talk more about reasonable salary in a minute, but this is really important because your reasonable salary is the portion that you're going to have to pay full taxes on, income taxes and self-employment taxes. Okay, so we'll show you how that works and how that kind of splits out. But let's just say $100,000 in profit, $60,000 is what you're going to say your reasonable salary is. All right. So here's kind of how that would play out. Here's what that looks like. Again, that $60,000 is essentially compensation for being an employee in your business. That's the best way to look at it. You are compensating yourself for the work you are actually doing actively in your business, okay? So oftentimes this is determined, there's lots of different methods for coming up with reasonable salary. The biggest one that I use is the many hats approach or the cost approach, which is basically saying how much, if I divided my time and figured out what I'm spending on admin tasks, what I'm spending on marketing tasks, what I'm spending on all these different tasks, and went out and did some research to figure out, okay, if I hired people to do all this for me, how much would it cost me, right? That's what your reasonable salary is, essentially your replacement cost, which I know gets tough because we always think we're irreplaceable as business owners. But I will tell you the best businesses are the ones where you are fully replaceable. So that's what you're kind of trying to figure out is what would the replacement cost be? So that's your compensation for being an employee of your business, for doing active work in your business. Now you might be thinking, well, I don't actually actively work in my business. Maybe you fully, you have a team and you don't work actively in your business. You might actually be able to get away with either, a very low reasonable salary or even no reasonable salary. Okay. But if you are actively working, you are going to have to pay yourself a reasonable salary. You're going to have to withhold taxes on that. And that's going to be taxed when you pay yourself. So it's just like essentially paying yourself through payroll, just like you would any other employee. And you're going to be assessed income taxes, of course, because we get income taxes assessed on basically any income we make. And you're also going to get assessed those payroll taxes, right? So you're going to pay both the employer and the employee side of it. So it's going to add up to 15.3% on $60,000. However, and here's where the beauty of the S Corp comes in. What about that remaining net profit, right? We made $100,000. Reasonable salary we said was $60,000. What happens to that $40,000? This is where the benefit of being an S Corp kicks in. This is what's available for owner's draws. This is essentially seen as, I like to think of it as more the income you make by being an investor or shareholder in your own business, right? So you have money you're making because you're working actively in your business, and then you have money that you're making as an investor. Guess what? In the United States of America, we're actually taxed at lower rates on passive income, non-active income. So you get to put a portion into kind of a more passive bucket. That means you have income taxes, yes, of course, but not self-employment taxes. There are no payroll taxes on this portion of your income. Okay, so this right here, if you want to take a picture, this is how you save money as an S corporation, because a portion of the money, the profit that you're making, does not have self-employment taxes on it. So when you hear people talking about saving money as an S corp, this is what they mean. Okay, so hopefully that makes sense. And again, I'm going to show you with some actual numbers. What does that mean? Okay, here's some numbers. LLC tax as a sole proprietor. That is the default. You create your LLC. You don't make any tax selections. You're going to be taxed as a sole proprietor, assuming you're a one-person LLC. In this case, we're talking about one-person LLCs because partnerships get a little bit trickier because you have multiple people that you're dividing this among. But in this case, you're an LLC taxed as a sole proprietor. So total profit, like we said, $100,000. We're not going to pay ourselves a W-2 salary because we're taxed as a sole proprietor. So you don't ever pay yourself if you've not elected to be taxed as an S corp or you're not a C corp. An LLC is never going to pay W-2 wages. You don't issue yourself a W-2. You are only doing owner's draws, but those owner's draws do have self-employment taxes on them. So it's a little confusing. However, you're not going to be, withholding taxes through payroll specifically. But that whole $100,000 in this example is subject to income tax, of course. And the whole $100,000 is subject to self-employment taxes because we are just default tax. So we get all the taxes. So let's just assume a 25% effective tax rate to make things easy. I like round numbers. Let's say that that's you. Your total tax then would be $40,300. Now, again, this is a very simplistic example. We're making some assumptions on things like tax rates, right? So don't take this to be gospel. This is just for comparison purposes. So then what if you were an LLC taxed as an S corp and you paid yourself $100,000 in profit, but $60,000 was taken out as reasonable salary, and the other $40,000 then would be kind of that profit above and beyond your reasonable salary. in this case, you can see I've highlighted where the differences are. The main difference is going to be that only that $60,000 is subject to self-employment taxes. Okay, so your income tax in this simplified example is the same. We'll talk about in a minute why that might not necessarily be true, but in this simplified example, let's say your income tax is the same, but you get that decrease in your self-employment taxes. And in this example, as a simplified example, you would save about $6,000 by being an S corporation in again, this very simplified example. So I want to say this a lot because I'm going to bust my own myths here in a minute. This is kind of what we call the back of the envelope calculation for a CPA, but a CPA should be doing a lot more than this to actually analyze whether it makes sense for you. And we'll talk about why that is in a minute. You would want to use your own numbers, your own financial situation in order to determine what the actual savings are. But this is just to kind of illustrate how this actually works with self-employment tax savings. Grab some water. Okay, so let's do one just, to drive this home a little bit more with some more numbers. Let's say you make $175,000 in profit, okay, before paying yourself. Maybe you have a team or something like that as well. And you determine that your reasonable salary is $50,000. You might be looking at that saying, well, could I get away with that? How could I get, if I'm making $175,000, how could I say only $50,000 was my reasonable salary? Well, there's a lot of different ways, not that you can get away with it, but that you could potentially justify that. Like I said, if you have a team that's doing a lot of that income generation, maybe you only work 20 hours a week, right? And your team is really the ones doing like a lot of the grunt work and generating the revenue. Maybe you are more passive in terms of what you're doing for the business. In that case, you can potentially justify a lower reasonable salary. We're going to talk in a minute about how some CPAs use these rules of thumb, but those rules of thumb can actually end up costing you money, more in taxes than you would really need to be paying. This is an example of, where your CPA might tell you, well, you need to take at least 50% out in salary, right? But in that case, that means a much higher reasonable salary than maybe what you could justify otherwise. So again, we're going to talk about that a little bit more, but let me just show you this example and how reasonable salary really matters when it comes to how much your savings are going to be, right? That's why it's important to really do a detailed analysis of this. So in this case, $175,000. Owner W-2 salary as an S Corp would be $50,000. So only that $50,000 is going to be subject to self-employment taxes, right? And so when you actually do this back of the envelope calculation, you're now saving $19,125, right? So you are actually saving quite a bit more in this, again, very simplified example. You would be saving quite a bit more. And the reason for that is because now you've got a lot more of your income that is not subject to self-employment tax, right? So you can see how this can really vary based on your situation and how much your business is making and how much you can justify as your reasonable salary. So here's where like all my but, because of course it can't be that easy. Like us accountants have to make money somehow. We can't make the rules that simple, right? We have to make this more difficult. So here is where I'm not going to go into a ton about the qualified business income deduction, but the thing to know about this, and this is actually a hot button topic right now as we speak as well, because of what's going on in Congress. But in 2018, the Tax Cuts and Jobs Act was passed. It basically put a 20% qualified business income deduction for businesses that are pass-throughs. So that's probably most of you would qualify for this. Now, it affects S Corps differently than LLCs, right? Because it's going to be calculated off of your reasonable salary. So this is where it can, this is where you'll want to do a more detailed analysis because QBI also needs to be considered and the impact on QBI between when you are an LLC versus an S Corp. So that's why these like simplified examples, as much as I love them, are not going to actually be correct because there's no line on here that shows me the qualified business income deduction impact between being an LLC versus an S Corp. And there will be an impact. There will be. And it's going to be highly dependent on your situation. Now, why is this important right now? So This actually expires, the QBI deduction itself expires at the end of 2025. The Tax Cuts and Jobs Act essentially had it was a temporary thing, and they're trying to make it permanent now. So the bill that's currently going through Congress that has a lot of kind of the tax extensions related to the Tax Cuts and Jobs Act, this is one of them. And in fact, the latest version of this I saw actually increased it from 20% to 23%. So this is something to keep an eye on because this will impact businesses. QBI definitely has had the impact of reducing small business taxes. And so if that gets extended, they're actually trying to make it permanent as well. So I personally am a big fan of certainty, right? Of having some line of sight. Uncertainty is the enemy of business. So hopefully this gets sorted out so we know where it's going to land. I don't love these, 5 to 7 year time horizon things that then expire and then we're left kind of wondering what's going to happen. That's this kind of year for CPAs. We're kind of like, okay, wait and see. Like, this may not actually be the year to elect S Corp until we have a little bit more certainty on what's going on with the tax law. So if you haven't made that decision yet, it might be time to wait and just watch what's going on through Congress and see if this gets passed and see what the ultimate QBI is, because it is going to impact your calculation one way or another, right? If QBI goes away entirely, the calculation is very different when analyzing S Corp versus LLC. Okay. There's also lots of variables that can impact this. So again, some of that's because of QBI, but there's going to be limits that will come into play, Social Security limits, right? So it's not endless. There is a Social Security limit where you're already not getting taxed on you're not getting Social Security taxes past a certain point. I forget the exact number right now, but
hey Jamie, one more try on the mouse movement. Oh, there we go. Yep. It's very strange that it's doing that.
I don't know why it's lagging like that. Sorry about that.
No worries.
Thanks.
Right,
just tell me if that, just let me know if that keeps happening. Okay. But so there's limits to consider. Your specific situation, it impacts it as well. So again, QBI, there are phase outs for QBI. It depends on your total household income. So if you're married filing jointly, you might have to, consider what impact your spouse's income is going to have. So it's just a more complicated calculation than the simplified examples I gave you before. Those are helpful for kind of thinking about, should I pursue this? But before you make a decision, you want a more detailed analysis to be done. And then, of course, as you can probably guess, your savings are going to be highly dependent on your reasonable salary. So the higher the salary that you take, the lower your tax savings, right? So let's talk about this a little bit with a comparison, including QBI, just to show you how these types of things can have an impact. So let's go back to that first example. You make $100,000 profit in your business before paying yourself. You determine your reasonable salary for the work you do in your business is $60,000. Okay, this is that simplified example. Here now we've included this QBI deduction. So what you can see is now, right, in this case, the full 100,000 as an LLC would have been eligible for the QBI deduction. Here in the secondary example, only your reasonable salary portion. So while we're still seeing down here this self-employment tax, right, we're saving there because our self-employment tax has gone down. What's happening to income tax? Well, our income tax is kind of offsetting a lot of our savings because we didn't get the full QBI deduction for income taxes. Right? So yes, we're going to save in self-employment taxes, but that's going to be offset by income taxes. So net, in this example, we'd only be saving $1,000. In my opinion, I would not advise someone to become an S Corp to save $1,000. Why? Because it costs more to be an S Corp, right? So you're going to spend more than that just being compliant with the rules and the extra tax filings and payroll and all of that. This to me would not be a compelling reason to switch. Okay, so that's why it really matters. Again, we take QBI out of this and it could absolutely make sense. Now you're talking about a $6,000, $7,000, change in what your taxes would be from one to the other. But this is why it's important to have a more detailed analysis done to make sure that you're capturing the impact of the current tax laws, which are currently changing. So yay for us. Okay, so this is also, like I said, reasonable salary impacts this quite a bit, quite a bit. So what effect does reasonable salary have? Well, in that example we just did, right? So in this example, we saved $1,000 for being an S Corp. Well, let's say though, we could justify, maybe we don't work actively in our business, right? And we could justify that instead of taking that, $60,000 reasonable salary, we're going to take a $0 reasonable salary because we have staff that manages the whole business for us. Okay. Now you're saving $13,000. So if you're not active in your business and you can justify any of these lower reasonable salaries, it is quicker to the point where it can make sense for you. If you are a solopreneur, self-employed, right? And the IRS comes knocking and says, well, why did you take a $10,000 salary when you made $100,000? It's going to, and you work full time, right? You're working 40, 50, 60 hours a week in your business. It's going to be a little hard to justify that you could replace yourself for $10,000, right? So those are things to think about when it comes to setting your reasonable salary. How much are you actively working in your business? Because you can go from a savings of $13,000 in some scenarios to actually costing you $7,000 more in other scienarios, right? So that's just something to really be aware of and make sure you're calculating. This is not a one-size-fits-all solution. And that's where I have like a beef with this around social media and TikTok and how people just say, become an S Corp, it'll save you all this money. And I'm like, hang on. I literally just talked to somebody the other day that their business made like 12 grand total all year and their accountant had set them up as an S Corp. And I was like, oh dear Lord, this is a nightmare because now you're going to have to be compliant with all the rules and you are getting zero tax savings at the end of the day for something like that. Okay. So common tax strategy, you can probably guess, minimizing salary, taking money out as draws, but be careful. Be careful. Again, the IRS will come, they'll ask questions. You want to be able to justify that. So there is a thing called a reasonable compensation study. It's actually something that my company offers. We partner with a company called RC Reports, and you can actually do a detailed reasonable compensation study that looks at all the different things that you do in your business and pulls all the relevant data from the U.S. Bureau of Labor Statistics to come up with what your reasonable salary actually should be in your business. And then you have a report that if you are ever audited, right, you can give that to your auditors. And in my experience, it has been some of the most ironclad proof that you have. It's much better than, well, I just take 50% out of my profit out in reasonable salary. They may agree with that. They may say, how are you getting to that? How did you derive that? And then they might come up with something higher if you don't have good support for what you're doing. So just make sure, right? It's a risk tolerance situation, but you don't want to pay more in taxes than you need to. So you don't want to set too high of a reasonable salary, but you also don't want to set too low of a reasonable salary and put yourself in jeopardy of, audit, back taxes, things like that. So that's where this is an important thing to be working with an accountant on, or hopefully getting a study done for yourself. Okay, S Corp requirements. So what does it mean? So let's say we've decided to be an S Corp. It's going to save us money. There are some things we need to know, and this is again one of those things that some business owners aren't as informed about as they should be, and so they end up missing things that they're supposed to be doing because maybe their accountant didn't tell them, or they just weren't fully informed. So again, talked about this, pay yourself a reasonable salary. This came up a lot actually in COVID because there were a lot of S Corp owners that were not paying themselves a reasonable salary. And the reason this came up was because to be able to be eligible, especially at the beginning of COVID, for PPP loans for y'all, some of y'all, that's going to be like a PTSD response like it is for me. But with these PPP loans, it was based off of your salary if you were an S corporation. Now, if you were an LLC, it was based off your profit. And people didn't understand, well, why am I not eligible for anything? And it's because they weren't taking out any kind of reasonable salary. So from a PPP loan perspective, they, were eligible for nothing because it was just based off of what you were paying payroll taxes on. So I think a lot of people at that time realized, oh, shoot, I didn't even know this was a requirement, and then had to kind of scramble and figure out what to do. You also need to withhold taxes. So again, you are, in this case, you're an employee of your business. So you're going to withhold those payroll taxes and those income taxes from your own paycheck, right? You're probably going to want a payroll provider for that to make sure it's done correctly. We highly recommend doing that versus managing it yourself. And then you're going to have an extra tax filing that you wouldn't have if you were a single member LLC. So you're going to have an 1120S. This is due March 15th each year. So it's due a month before your regular personal return. And so that's going to detail out your income and your expenses and the total profit in your business. And then that's going to be used to generate your K1. And your K1 is kind of akin to like a W-2, right? Your K1 is going to be what your business sends you. That's the portion of profits that you need to claim on your individual income taxes. Because remember, an S Corp is passed through. So you're not going to pay any taxes at March 15th on this 1120S. Instead, what you're going to do is essentially find out what portion of the profit of your S Corp you have to then claim on your individual return, in addition to your salary that you're going to get a W-2 for. So you're going to get a W-2 for that portion. For your salary portion, you're going to get a K-1 for the profit, right? So that's kind of just an important thing to know. If you have multiple partners, they're all going to get K-1s. It's going to split up that profit based on the ownership percentage. And that's how those K-1s are going to, determine how much people are going to be taxed that are partners in the business. So those are all things you need to do, right? So those are extra requirements. Those are things you don't normally have to do if you have an LLC, right? There is more that you need to be aware of. So what does that cost? And again, when you're having this conversation, if your accountant tells you you're going to save $5,000 by being an S Corp, the question to ask is, does that include all the extra costs that I'm going to have to pay, in some cases to you, the accountant, right? So if you're going to save $5,000, but then when you add up the additional costs, it's going to cost you $4,000, then it may not make sense, right? So that's a payroll service. Payroll service is typically, if it's S Corp owner payroll, you can get it for $40 or less a month. So it's not that expensive. And I do recommend having a payroll service to make sure your 941s get filed. They're going to file your W-2s, all of those types of things. Make sure you stay compliant, withhold the taxes from your paychecks, all of that. That 1120S filing, that can get expensive. So that's a whole nother tax filing that you might not otherwise be doing. So that can eat into some of your savings. Accounting costs. Your accountant's probably going to charge you more, right? So if you have an accountant that you're utilizing, not just for tax preparation, but for just staying compliant in general, they're likely going to charge you more. They're going to need to do more complex. They have to, track basis, things like that they don't have to do otherwise. So your accountant's probably going to charge you more if you are an S Corp versus an LLC. You may have lower retirement contribution limits as well. So this was something that doesn't get talked about a lot with S Corps, but I am a person who likes to max out my retirement. If you have a SEP, if you've got a 401k, something like that, depending on the type of retirement plan you have, it can impact it. So this is something you'd want to talk about with your financial advisor too, because it may change your strategy around putting money into your retirement accounts, and it changes how they calculate the total max that you can put into those retirement accounts based on whether you're an S Corp or an LLC. So I have found that often S Corp owners get a lower, just because of the way that it works out and the calculations of the limits, they can contribute a little less than most LLCs can to their retirement accounts. So it's just something to know about. And this is a fun one. I live in Tennessee, y'all, which means we have a franchise and excise tax. I don't have to pay that. If I was an LLC, I wouldn't really have anything to pay for that. However, it's assessed on anything that I don't pay payroll taxes on. So in Tennessee, I actually have to pay quite a bit on a monthly basis, or not a monthly basis, on an annual basis to the state of Tennessee for this franchise and excise tax as an S corporation. So that offsets some of. It still makes sense. I am taxed as an S corp now, but it eats into some of that tax savings. So again, you want to make sure if your accountant's coming to you and saying, "Hey, here is how much this is going to cost you," right? Or how much this is going to save you. You want to make sure that it includes, like, ask questions like, does that include QBI? How much is it going to cost to stay compliant? And does that include any potential state impact for state specific taxes and laws? Most states it doesn't affect you much, but in certain states there are additional taxes you may have to pay as an S corp versus an LLC. So that's just something to make sure is included when you're looking at that. And here's one of my favorite sections. And I love my tax pros, I really do. But here are the things. Here's how to know if you're a tax pro. might not know what they're doing with this. Not everyone is fully versed in all of this. So if they're just making a recommendation for you, if all they asked you was how much profit do you make, and they're like, oh, okay, if you make more than $50,000 in profit, you should be an S Corp. And they don't follow that up with, let me do a full analysis, including QBI, et cetera, and show you these numbers, right? And show you, like, let's say how this would have affected you using your numbers from last year. Here's what it would have looked like had you filed as an S Corp, right? If they are not doing that, and it's just kind of this back of the envelope calculation like I did earlier, they may not be fully versed, right? Because they're not really thinking through the nuances that can heavily impact the savings that you could be eligible for. So make sure before you make any elections that you've seen the numbers and it's an actual deep dive analysis on your specific situation. I also see them recommended too soon. Like I said earlier, literally it was a company that made like 12 grand and they were taxed as an S Corp. And I'm like, man, you're going to have to pay thousands and they hadn't run payroll for themselves, of course, because they didn't tell them to do that. So you want to make sure you're working with someone that's going to educate you on what those requirements are, or that you're going to be educated yourself to make sure that you're asking the right questions. Because at the end of the day, if an 1120S doesn't get filed, that's on you, not your tax preparer, actually, right? You are responsible for knowing what those requirements are. I know people that were elected to be taxed as an S Corp years ago and never knew that they had to file an 1120S, and they kept just filing as a Schedule C. And that was a big mess to clean up at the end of the day, right? And so like you want to make sure that your tax pro is educating you. If you're working with them, if you're paying them to help you with this, they should be educating you, and they should be educated themselves on what their requirements are. If you're not profitable yet, or if you can't afford to pay your reasonable salary, you shouldn't be an S Corp. Full stop. And the reason that I say that is because a lot of people ask me this, where they're like, well, wait a second, I make $100,000 in revenue, but you know, my profit, maybe your profit's only 20 grand, but your reasonable salary is supposed to be 50 grand, you know, when you do that calculation. And people say, well, what if I can't afford to pay myself my reasonable salary? My answer to them is, you shouldn't be an S Corp because there's no benefit to you in being an S Corp. Remember, that second bucket only kicks in to the extent that you have profit above and beyond your reasonable salary that you won't have to pay payroll taxes on. If you can't even pay yourself your reasonable salary, you are not benefiting by being an S Corp at all. And in fact, you're just paying extra money to be compliant with rules that aren't benefiting you, right? So I get very like, this is where I'll get up on my soapbox and talk about it, because for the amount of people that have told me they are S Corps and can't afford to pay their own S Corp reasonable salary, your accountant should have never advised you to do that. Unless maybe you have one like tough year, right? That's a different story. If we're talking like 1 year out of 10, you can't pay your reasonable salary, it's not a huge deal. However, right, if that's continuous, or if you just haven't grown your business to the point where, you know, you can pay that reasonable salary yet on a regular basis, it doesn't make sense to be an S Corp. And you might want to even revoke your S Corp election. You can only do that once every 5 years, but there is a process to revoke an S Corp election if it doesn't make sense for you and you want to go back to your default treatment, which if you're an LLC, that would be being taxed as a sole proprietor. And another thing, this one grinds my gears probably the most out of all of them. These rules of thumb to set your reasonable salary. 50-50 or 60-40 rules of thumb for splitting your reasonable salary and your additional profits, right? Your owner's draws. That is not found in any IRS guidance. It is more than likely setting you up in a lot of cases to pay more taxes than you need to, and it's not protecting you from IRS audit either, right? So you're not doing either of those things. I literally hate these rules. They're fine to use when you're first just estimating whether S Corp could make sense, but don't set your reasonable salary based on this and think like, well, I'm taking 50%, so I should be good, right? There are better ways to do this that are going to be able to help you hopefully potentially justify paying less in taxes and being actually compliant with the IRS and having, you know, some actual guidance that you can give them to support your reasonable salary and make you less prone to audit. So please just don't use these. And if your accountant says this and doesn't, offer to do a more detailed analysis, come get an analysis done because I'm telling you, this is one of the biggest things I see CPAs say this all the time. Okay. Now we got our myth busting. Let's do some myth busting here. We're getting close to the end, guys. So go ahead and put your questions in if I haven't addressed what you wanted to ask. But some myths are that S Corps always save you money. They don't. Obviously, administrative costs, additional, state taxes can offset that. And again, if you can't pay yourself your reasonable salary, it's not going to save you any money. So hopefully you're taking that away from this. You should be an S Corp if you make profit over a certain amount. No, there is not a line at which it makes sense. Now, over say 50,000, 60,000, 70,000 in profit after expenses is a good time to start thinking about it. That's a good trigger to go get an analysis done, right? To determine if you're in that zone yet, but that is not a good zone for making that decision. It's highly dependent on your tax situation. And then there's the myth that they're just not worth the trouble. You might be listening to all this and you're like, okay, I don't want to deal with this. This further solidifies that it's not worth the trouble. There is real ability for tax savings here. Yes, there are some headaches, but if you have help with it, it's not so bad. So you just want to make sure you're doing your due diligence before you make any decisions. Okay, so here's just a quick step-by-step, and this will be a good slide to take a picture of when I'm done. So I'll leave it up for a minute at the end. But this is kind of the recap of what do you need to do. If you've decided S Corp, or if you're trying to decide if it's right for you, what are the steps to follow? So first, we're going to look at your total profit. Again, if it's under 50,000, it's not going to help you yet. That doesn't mean it is going to help you if it's over 50. But if you're under 50, you don't have to worry about this. Go hang out, go sit by the pool for a little bit and stop thinking about S Corp because it's not right just yet for you. If you're over 50K in profit, now you might want to think about doing a more detailed analysis. Again, that doesn't mean it's going to be beneficial. I typically do see this being higher. For me, it was over 100,000 in profit before it made sense to be an S Corp. Again, I live in a state where I'm taxed more as an S Corp, so that's part of the reason. But that's a good trigger point to go talk to somebody about whether it makes sense. You can start by estimating a reasonable salary. For this, at this point, before you've made the decision, you can use a 50-50 or a 60-40. That's fine for just kind of getting an idea for the calculation, right? But later on, you're going to want to get something a little bit more foolproof, a little bit more IRS proof when it comes, when you do elect S Corp and are actually setting a reasonable salary. Then again, here's where you get that, CPA to perform a full tax comparison. Use a trusted CPA. Again, use some of the things that I've talked about in here to help you determine if they know what they're talking about. If you ask them about QBI and they look at you like you're a crazy person, that's probably not the pro for you, at least not for this specific task, right? And we do have some affordable resources that you can grab on my website as well. That is something where it's more of a done with you type of situation. We are not a full service firm, so I don't do taxes, but we do reasonable compensation studies, things like that for business owners to help them out. And if an S Corp is expected to save you money, this is when you're going to elect to file or elect to be taxed as an S Corp. You do that by filing Form 2553. It's a one-pager. It's really easy. Actually, I think it's 2 pagers, but it's a really easy form to fill out if you know how to do it, right? If you know how to do it the right way. And you do already want to be an LLC before you do that. So you have to be an LLC to elect S Corp or a C Corp to elect S Corp. That deadline was March 15th. So we're now past the deadline for 2025, but there are some ways that you can file a late election and maybe get it even to be able to be effective as of January 1st of this year. There's some extra information you'd have to give and kind of tell them, hey, I've been operating as an S Corp and here's why this should go back to January 1st. I don't recommend mid-year switches. So sometimes you can elect and maybe go back to June 1st or July 1st, right? You can do that if you wanted to do it mid-year, but it's kind of a nightmare come tax time. So unless you really are going to save a ton of money from a tax perspective, I typically recommend, trying to get it backdated back to January 1st of this year, or if you can't do that, starting at January 1st of next year. It's just so much easier when you're not having two different types of entities that you're now having to file taxes for at the end of the year. So I typically recommend that just to simplify and make things easier on yourself. Then you're going to finalize your reasonable salary, and you're going to set yourself up on payroll. Again, $40 or under a month. There's several different payroll services that have S Corp only payroll that you could use. And then again, stay, informed. Make sure you understand requirements. Again, make sure you're filing that extra business tax return, that 1120S. You're tracking your basis, which is essentially your shareholder ownership interest in the business. Those are things an informed accountant can help you do. Setting up an accountable plan, which is basically a reimbursement plan to make sure that you aren't paying taxes on things that should be tax-free reimbursements to you as the business owner. So again, ask your CPA a little bit more about an accountable plan. If they don't know what you're talking about, that could be a red flag. But those are things that you want to get set up for yourself to make sure that you're getting the best tax treatment as an S Corp. Okay, and that's pretty much all I had today. So we're right, we have enough time for some questions. If you want to learn more, my website is just jamietroll.com, or you can go, I have tons of resources on YouTube you can check out. I have a free S Corp success checklist you can grab. There's a toolkit out there, like I said, that'll help you make that assessment yourself. And we have our reasonable compensation studies and reports. So go to my website, you can see all the things that we offer related to this. And because I just have to put this out here, this is my book that's coming out. So if you want to support a new author, it is extremely appreciated. jamietroll.com/hidden profit. You can order on Amazon. You can pre-order it on Target, Barnes & Noble, independent booksellers. It is out there. I would love to have your support as a new author. It means a lot when people pre-order the book. So
Hey,
thank
Jamie,
you guys so much.
Move your mouse so they can see the book. There it is. Yep.
Oh, okay. Sorry. Yep. Got it.
Yep.
Here's the book. Here's the book. So here's my, let's see, hang on. I have it right next to me. This is my early reader copy. So it's really cool to have a book that I wrote in my hands. Anybody who's written a book, it is a much bigger process than you think it's going to be. It's been 3 years in the making on this. All right. Perfect.
Okay, Jamie, this is Beth Melito here, and we have a ton of questions. We're not going to be able to get through them all, unfortunately, and including several people that are asking you to come back and talk about when it would be a good idea to switch to a C Corp. We had probably at least 4 questions on that too, and I put in the publish too that we are inviting you back right now. I'm inviting you back at some point because there are people wondering about switching to a C Corp. Or alternatively, we actually had 2 people that asked whether or not they should switch from an S Corp back to a sole proprietorship too. So there's a lot, and I really liked your statement too about, the time to make the analysis versus the time to make the decision. So first you go through the analysis part. That's very important there and very, very good advice. So, and also I want to say that I have advanced ordered my copy of your book and I am so excited. I cannot wait to see it. I'm just congratulations to you because not only ordering the book is supporting a new author, but we're supporting a small business owner too, which is just so incredibly exciting. So we had one question. First question here I have from Sal. Do you have to take a salary in an S Corp if you already have a salary from another company? Does that impact the reasonable salary requirement?
It does not. So the reasonable salary requirement is specific to that company. So regardless of what other income you make, if you are working actively in the business, now it could, if you're, let's say you work a, normal full-time job and get a salary, well, your salary for your S Corp might be lower because maybe you're only working 5 or 10 hours a week, right? So if that's the case, you can probably justify a lower reasonable salary because you're not working full-time in your business, but ultimately just because you have another salary, it doesn't really impact, the requirements to pay a reasonable salary from the business.
Okay, and I'm chunking together or combining 3 questions that we had on medical benefits and how payments of medical insurance impacts taxes when moving from a sole proprietor to an S Corp. So, if the business owner pays the health insurance personally, how would that impact any health insurance deduction?
Yeah, so that can get that one can get a little bit tricky too, right? So that's something you're going to want to talk about depending on your health plan and how that's being done. If it's being paid, it does matter whether it's paid by the business versus by you personally, right? So the deductibility is going to depend. A lot of times with S Corps, it does make sense to pay that from the business. You're going to get better tax benefits by doing that. But you typically can, there is some deductibility even if you're paying it on the personal side. Some of it's going to depend whether, if your spouse has a job that they have access to healthcare, then it may not be deductible. So there's a lot of rules around health insurance. That is something to dive into your specific situation with an accountant to see. But I do find that most of the time it can make sense for an S Corp owner to pay that from the business, and you're going to get more benefit doing it that way than if you're paying it personally.
Okay, and we had several questions on the draws versus the weekly salary and the breakdown. So again, I apologize. I'm combining for those that sent in questions related to this topic. I am combining some questions here so we can get to more. But if you're an S Corp, is it advantageous to take a small monthly distribution check and a larger salary, the reasonable salary, or more on the draw side versus the salary? If you have any insight on that.
Yeah. The more draw you can take, the better, meaning the lower you can justify a reasonable salary. Now, there are some, just from a self-employment tax perspective, right? That's going to save you the most money if you have a lower reasonable salary and you're taking more in draws, because those draws won't have payroll taxes. One thing to note, though, that is something to consider, I think the taxes now are better than potential Social Security someday. But that's something to note too. If you're paying in less to Social Security now, it's less wages that are going to be calculated in your Social Security benefits later when you retire. So, to me, again, I'd rather you get the tax benefit now, maybe invest that money. It's probably going to turn into more than what the potential Social Security benefits would be. And we also don't know what Social Security is going to look like in X amount of years. So that's just something to know. But in general, from a payroll tax perspective, you're going to pay less in taxes now, the lower you can justify a reasonable salary. But that's the key, is to be able to justify it.
Is there a link, or are you aware of any IRS guidelines for the reasonable salary calculations? That's a great question.
Yes. Yeah, there is. There's a lot you can look up. I would Google something like IRS. Look for an irs.gov site, first of all, because that's really important. There's a lot of sites that masquerade as tax, official tax sites, but if it's not a .gov, it's not what you want to be looking at. But you can look at things like, look up the cost method. You can say cost method, reasonable salary, or something like that, and IRS, and you can find some of the guidance related to it. So there's a market approach as well. There are various different ones. I find the cost method to be the easiest one because it's, like I said, you're essentially going to replace yourself. It's also called the many hats approach. So if you're a business owner that is wearing many hats in your business, right, you can actually carve off and say, well, I spend actually 5 hours a week just doing admin duties. And if I hired someone for those admin duties, maybe it'd only be $16 an hour, right? So instead of having to, replace yourself all with CEO pay, it's like, how do you actually look at the job duties you're truly doing in your business and carve that up? And that's an IRS approved methodology. You will not see anything about 50-50, 60-40 splits anywhere in IRS guidance. So that's why, looking at that guidance and reading it and kind of trying to understand what that means for you is really a great thing to do.
And we are up on the hour right now, but I do want to share with you, Jamie, that the feedback here already in the box is just, this was outstanding. Yay. This was, why can more CPAs not talk like this? I wish all CPAs would explain things like this. You are just so good at simplifying what can be very complicated and honestly very stressful too for so many business owners. So I put in the chat box your website, and it's
Yes.
jamietroll.com, Trull, one word, JAMIETRULL.com. And I just published that too. So please check out Jamie's website because she offers so many resources on there, many of which are free. You offer fantastic social media. Your YouTube videos are outstanding. If you have not signed up for those, please do so, because all of your talks are this easy to understand. So thank you so much. If there's anything you want to say, I'm going to kick it back to you. If you anything else you want to say to close this out today, but thank you so much, Jamie.
Well, that's the best compliment I can get. So I appreciate that because I'm smiling ear to ear. I really like trying to take these complex topics and break them down and get rid of some of the gatekeeping in the accounting industry where we try to hold all the knowledge. I think it's really beneficial for business owners themselves. You don't have to know the IRS code in and out, anything like that, but just to be familiar enough to help you ask the right questions, make sure, that nothing's getting missed, right? That's what I really love to do. And a lot of people, can't necessarily afford, especially small businesses, to be working with an accountant or a CFO, year round. And so that's why I make the resources that I do, because I want you to be informed for yourself and your business so that you can grow it and hopefully then hire all the people because you'll have all the money to do all those things. But in the interim, I want to really be able to create these, affordable resources to help. So I appreciate the compliment. It means a lot.
Thank you. And thank you, Beth and Jamie, for joining us. And thank all of you for joining. That concludes our program. Visit nfib.com/webinars for all of our webinars on demand. My name is Casey for NFIB. See you soon.